I'm Rick Bensignor. Today is Tuesday, October 27th, and welcome to this week's In the Know Trader Show. Well, as we start taping late Tuesday morning, quick review of the markets. The S&P is down about 7 points on the day, continuing under pressure and following through from yesterday's fairly steep decline. Crude oil is up about half a buck, just north of $39. Bitcoin's up nicely today. I don't look at that often, but I see it's up 420 bucks, almost at $13,500. Gold's up $3.50, and let's see, what are we missing? The dollar's down about 15 pips or so today, just beneath 93 in the DXY. All right, well, as far as today, our agenda is the following. In our trader education portion of the show, we'll talk about timing and how important timing is in everything in life and markets. So we'll talk about that. In our market overview, we'll take a look at the Dow. We'll update you on the gold and what the dollar is doing. And then I thought this week we would take a look at a sector that I infrequently look at, but it's the utility sector. And the reason is in the last few months or so, utilities are the only sector that you would put kind of on the defensive side of the marketplace that is actually up versus the S&P. It's up a little over 2% in the last 3 months. So the only other sectors that are up are the growth parts of the market: communications, technology, industrials, and healthcare. And healthcare sometimes is defensive, but energy, real estate, financials, utilities have been trailing, and it's sort of the one sector that's up. So we'll take a look at them today, and we'll go through about a dozen names or so, depending upon how much time we have. But I figured let's go take a look at that because, again, it's not too often that we do take a look at them. In order to contact me, it's Rick at inthenowtrader.com. And of course, to sign up for our weekly ETF Tactical Trader Report that comes out Wednesday nights, go to inthenowtrader.com. And if you're interested in trying to outperform the S&P and do so as like an active manager would, then sign up for our 7-11 report that comes out monthly, generally on the the last day of the month or the first day of the new month. And there again, we get you in no more than 7 of the 11 S&P sectors with the goal of outperforming the market by avoiding the underperforming sectors of the market. And after the first couple of months, we are up against the S&P, so we are doing what the goal of this newsletter is to do. Some people are just content in getting the average return of the market, so they'll buy spiders. And say whatever the market gives them is good enough. I like to think of that I run my life in an above average way in virtually all aspects of life. And so I'm not content with just getting the return of the market. I like to outperform the market. And if you're that type of person too, where you don't want to settle for just the average, then look into the 7-11 monthly report. Okay, let's go to talking about timing. So the several minutes that we're going to allocate now to this portion of the show, for a long time, back in, I guess it was 1997, I had joined Bloomberg from Morgan Stanley, and they had hired me as their head of everything relating to commodity markets, futures markets, and technical analysis. And I designed Bloomberg's entire charting system that's in use now. It's been updated since I designed it, but I brought it from a very Stone Age type of platform that they had to a much more modern point-and-click type platform. And as a whether you subscribe to Bloomberg, their professional software, or you work there, which of course you get the software for free as an employee because you're trying to sell it, in your email, you have the ability to keep a tagline. on your message so that every message you send has that tagline. And then, of course, you type what your message is. My tagline was always, for all the years I had a Bloomberg, which included the 3 years I worked there, as well as the, 15 years or so subsequent to that, that I was on the street with a Bloomberg, my tagline was always the same. And it was, in markets and in life, timing is everything. And I want you to think about that for a moment. And let's put markets aside for a moment. Just think about in your life, how many times you avoided some type of bad thing occur, all the way up to maybe even disaster occur, simply because of timing. So to give you an example for myself, and this is something I never forget, back in 1993, the first time terrorists bombed the World Trade Center, I was trading on the floor of the Commodities Exchange. That was in 4 World Trade Center. And remember, this was the time that the terrorists put a bomb in a van parked underneath the World Trade Center in one of the parking lots underneath it. By chance, and nothing more than chance, that day I happened to have taken the day off. So I was home and watching, news or whatever, and saw what happened and thought to myself, my God, I am almost, I'm there every day. And I certainly would have been affected by this, except that just for luck of timing, it happened to be the day I took off. And you can think, for yourself, the amount of times that timing comes in your life, that timing comes into play to have just by chance kept you out of trouble. You can think about getting bumped off of an airline flight, and you're all ticked off, and why'd you get bumped off? And the airline puts you on the next flight, and subsequently you find out that the flight they put you on got in earlier than the one that you were bumped off of, because the one you got bumped off of sat on the tarmac for 4 hours for some reason, whatever. Timing, luck, all these things come into play in life. And think of timing that, I'll take an extreme example, but something like if you plan on asking, a woman you're gonna ask somebody to marry you, and you plan it for this coming Saturday night, and you have your family and friends nearby, and it's going to be a whole big surprise, and she doesn't know what's coming. Except that afternoon, you and her, whatever reason, there's a big fight, and you're thinking to yourself, this is really bad timing. I've got this whole thing planned, but this is not a good time to go ask somebody to marry me. And, things like this come and go in life frequently, where timing and luck have a big play in how things work out. And when you turn that to the market sense, good timing is often very critical for success, both in life and in the markets. You can have the right idea in the market, but if your timing is wrong, you can still get your rear end handed to you. You lose money, and then what you thought was going to happen happened, but it happened subsequent to when you thought so. And if you play the options market, you have to get the timing right. You have to get the direction right, but you also have to get the timing right. And if your timing is wrong, your option can expire worthless, and the very next day, your stock can move up, 10% like you thought it was going to, except your timing was off. You picked the wrong strike price or the wrong expiration date, and it didn't work out. So you can often be right idea, wrong timing, and things don't work for you. So let's take a look at, let's go to some charts. So here we go. We'll pop up. Here's a chart of Apple, and this is a weekly chart. And you can see this goes back to 2013 or so. So we've got about 7 years of a weekly chart here. And obviously, wouldn't it be nice to get long somewhere down in here if you could have figured that out, somewhere down in here, and certainly somewhere near the March lows this year. And, you know, here we have, what am I writing, MACD down here. You could have maybe bought this signal at the time with a positive MACD crossover. Certainly there was one that took place in the first quarter, let's say February, somewhere around here when it comes to price. And then certainly if you had anything that could have gotten you long down here near 55, and you might have picked here, if I put up like a trend line, you might have said, well, somewhere around here was old highs, so maybe the lows come in. In that case, it happened to have worked. So I look at a trend line like this that is actually not even a trend line, it's really a horizontal line at a specific price. That's more like a static indicator, because that's not going to change over time. That's a flat price. And then if you draw, I don't know, let's just draw like a trend line or something like this, that essentially caught down the lows here. And if you could, if you bought that trend line and you know, notice that this area here had both the old highs and the current uptrend line, if you could have stuck through it when it traded down beneath where you got in, then obviously you did great. Those are static lines. But let's add some timing element to this. So let's put up aggressive sequential. So, excuse me. Notice here that in 2016, right near the lows, you had a timing signal, 9 consecutive Fridays, that the close was less than the close from 4 Fridays prior, known as a downward setup. That essentially caught the bottom. So from a timing point of view, you had something that helped you. Sorry, I'm coughing a bit. Notice here in late 2018, on that big sell-off into Christmas time, you get a timing signal that gives you the ability to get into Apple. Now, I'm not saying that, let's see, same thing, you could have maybe taken this low and drawn a horizontal line and notice that you had a bottom here and bottom here. But what I'm going to tell you is that to use timing models also give you much more confidence that what you're doing is right, because you're not always going to have the static levels. And something like this 9 up here, this was at the time like an all-time high. So you would have had really virtually any other reference points at the time. So here's a 13 for, this was an aggressive sequential upside exhaustion signal. On the all-time highs, we have the same type signal, calling for exhaustion of trend. And, you know, that's just an Apple. I don't know, let's take a look at some other high flyer and see if, okay, same thing. Long-term uptrend, you're looking to be buyers on pullbacks. How do you figure out when they come? 9 down on the bottom, 9 down on the bottom, 9 down here in 2018, pretty darn close to the bottom. 9 down a week or two. Let's see, what do we got? 1 week, 2 weeks before the lowest low in 2019. So I often am looking for timing models that can get me in the direction of the trend. And I'll use the ones that go against the trend also, but more so for taking profits. Occasionally I might short something if I really have belief that you know, there's a reason to go short the market or an individual name. But what I find most useful is using timing models along with traditional technical analysis to help pinpoint the likely turns and when it's best to buy something because of a timing element. So I like to think of market timing as being critical in how and when you make the decisions that you do. And that is, look, there's a reason why 20 plus years, it's actually 25 years ago, I came across the Mark models. I realized how helpful they can be. And I use other things too, but you know, there are things that Tom developed that I had never seen elsewhere, and to this day never seen elsewhere. So I give him a ton of credit for many of the models he developed and how I've been able to incorporate them over time into market analysis. And I think, you know, when you think about the type analysis you do, how much of it is static type of kind of horizontal lines and trend lines versus real market timing. And I would suggest that if you can incorporate real market timing into your decision making, you'll have a much better chance of making profits over the long run and finding the right times to come into something that has sold off sharply. You know, so that you get a real good idea of where to come in, not just from a standard technical analysis point of view, but also from a timing point of view. So read as much you can on market timing, and if you like the idea of being able to time when tops and bottoms can come into place, then that's a reason to kind of follow the work I do, because it has, I call myself much more a market timer than I do, let's say, a technical analyst. Pardon me while I cough again. Sorry about that. Okay, so now let's get back to here and move on to our market overview. So we're going to take a look at the Dow, gold, and the dollar this week. We'll start before that by going to. So I didn't do a broadcast last week. I actually had the chance to see my 92-year-old mother for the first time in 8 months, because the assisted living place she's in finally let people come to visit. And you know, this was all done very carefully. There's only one patient at a time that was allowed to be seen, and no more than 2 family members. But the good thing was we were able to see her last Tuesday, and so that's why I didn't do a show last week. So I don't have a week-over-week comparison like I normally do. But let's just take a quick look at year-to-date, the macro sectors, and you know, energy just continues to get bombed. I think the last time we looked at it 2 weeks ago was either minus 50 or minus 52% versus the S&P. It's now 55.5% beneath the S&P for the year, which is just incredible. Financials still the second worst, even with interest rates having moved up. They're still trailing the S&P by 25%. Real estate, which is also interest rate sensitive, is the third worst performer, down just about 14%. And as I say, utilities have actually done well the last few months. So they're only down 4%, but they were down probably 6 or 7 versus the S&P not that long ago. And industrials are still down and trailing the market. You've got your 3 leaders that are very clear: discretionary, communication services, and technology. And technology's come down. It's only up 21% versus the S&P. It had been much higher than that. So, you know, it has come in over the last couple months as they've taken some of the froth out of that sector just relative to the market. Let's go back to charts now and take a look at, let's start with, so market overview. Let's take a look. Here's the Dow on a weekly basis. Let's see, there we go. All right, so all-time highs are here in early 2018. Notice that the highs made, I'm sorry, that's 2020. But notice that the highs we've made since are lower highs. We have a downtrend line. And the recent high a few weeks ago failed to even take up the high from late summer. We are beneath the clouds conversion line. There's only really, let's see, 1 week back here. 2, so this is only the 3rd separate week that we've been beneath it on a lower close. So we're possibly in transition. Boy, I'm getting interesting. But let's also take a look at this on a daily basis. On a daily basis, here's that same downtrend line from the highs, but notice that we have sequential upside exhaustion signals here at the early part of October, double high against the early September high, and it's really important what's going on now, because notice the September lows came right to the bottom of a cloud. So you had a propulsion exhaustion level and the bottom of the cloud is support. We're through the propulsion exhaustion level right now, kind of by a little bit, just like we were here in September. And yesterday, the bottom of the cloud held. If we break down any more here, you probably increase the odds that we get down here in the Dow to 26,295. And that's going to be a pretty important level because that's just a hint beneath where the lagging line, this blue line, would get through the bottom of the cloud. If that happens, you go into full-scale sell mode on the daily chart. And in that case, you've got a pattern that would suggest lower prices. So, you know, we've got the election less than, or what is it, 1 week away. And how this plays out now is going to have a huge determination of what goes on for the next few months and the balance of the year. So I've recently been staying away from doing updates on the market itself that really gets to individual clients, but I wanted to make sure that you saw this. Here's gold, weekly chart, and gold continues to stay in between the weekly baseline and the weekly conversion line in the cloud model. So it's nowhere. Volatility should have come in. You know, option pricing should have been coming in over the last few weeks we've given up some volatility as we stay kind of caught in between this pink line and the yellow line. One of these days or weeks, you know, we're going to break out either way, and that certainly you probably have higher odds that that's the direction of the next move. So right now, for me in gold, the most important thing to pay attention to is both Friday closes above 1926 or Friday closes beneath 1880. Either one probably gets you the beginning of the next move. And the dollar. So the dollar is still above along this uptrend line here in purple, comes from the 2011 low. It caught the bottom, and here's perfect example of when I talk about market timing. Sure, you could just buy it because this is trend line, but the fact that the low was that when the market got to the low, you also had a setup 9 count, gave me much more confidence to take the chance that this was going to have a trading bounce. And that's exactly what happened. We had a month-long bounce that went right back to where the dollar index broke down from, and now it's pulled back. So very meaningful if by Friday of this week, which happens to be the last day of the month, if we break underneath 91 what was it, 91.80, I believe, you get a Friday close this week under 91.80, that would be negative because that would be an important level on the monthly chart. But it's the I think it's a TDST level on the monthly chart, so very important to watch what happened to the dollar this week. All right, let's now quickly look at some of our utilities. So let's look at the XLU by itself. You know, big decline March this year, making its way back. Clearly not near the highs, but in a setup up count. Again, one of the best, in fact, the only sector that's up in the last 3 months versus the S&P from the defensive side of the market. All right, let's take a look at some individual names in that space. So we're going to start with some electric utilities. That's obviously not correct. So I don't know what the chart's picking up, but there's some bad data there, or they did a stock split today. Either one, I'm sure the stock did not go from 300 to 75 in a day. Chances are it did a 4-to-1 split. So sorry, we'll just move on. Duke Energy, looking very similar to XLU. The only thing here is you're on an 8 count. So next week, if you get a 9 count above the high from last week, look for a possible pause here. as you just finish out the 9 count. So it could stall for a week, but generally, as long as this is above 84, the stock's good with long-term targets up at 107, 108. Southern, SO, similar look, kind of towards the top of its range. It's only on a 7, so look to see if it extends up to a 9 count, then pull back. It's already reached its propulsion exhaustion level here a couple weeks ago. Upside target eventually over time is just north of 70. AEP, stronger in the sense that the other ones we've looked at have mostly been towards the upper end of this kind of horizontal zone. This is broken out, so it's a stronger stock. This right now, I'd say, is the best of the 3 we've looked at. Still, I'd expect more upside. Any pullbacks in the next few months down to 84 is a buying opportunity. Exelon, EXC, not as strong. Notice, it's just kind of near where the high was from the summer. So ultimately, it's looking at 46, 47 type of target. Buying opportunity down to your 37.25. But this one's not as good as AEP was. XEL, XL, strongest one in the group because it's virtually on new all-time highs. So this is the strongest name. Open week this, opened down this week. It's come back. Let's see, last week was it down close. So if we close above 72.59 this week, and Monday gaps higher next week, as long as we take out this week's high, then next week this should move higher. So this is one of the best names out there, but it does need to close above 72.59 this week to help get an upside breakout. Let's look at some of the multi-line type of utilities. So we'll start with Dominion. You can see 13's help calling exhaustion to trend up over the last, actually all of 2020. Starting to move higher here too. I'd probably use this or this close here. So as long as it's above 77.05, it's okay, but it's not great. And next upside target is 86.25, and then 90.20. Sempra, SRE, looked like a lot of other ones, kind of in that box. Nothing special here. WEC. One of the better names, except it happens to be on a 9 now, so I'd probably wait for pullbacks instead of going after it now. And that tells me we've got 30 seconds left. We'll do one more Con Edison. And so broke out of that box, which came at a much lower level here. On a 7 count, this should still extend to a 9 count over the next couple of weeks. Pullbacks, 78.5 or so is the place to come in. Sorry, I had a couple of coughing fits along the way today. That's just one of those things that happens. But that's what live, that's what broadcasting is. Anyway, I am Rick Bensignor. This has been In the Know Trader. We'll talk to you next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.